The Chinese economy is experiencing a downturn, leading to ripple effects throughout the financial system. In recent days, an internal proclamation from China Merchants Bank titled "Save the Beijing Branch" has been circulating within the Chinese banking sector. The document reveals that as of March 10th, the Beijing branch's corporate deposits have shrunk by more than 80 billion yuan compared to the previous year, ranking last in growth across the entire bank. The release of the initiative to save the Beijing branch for corporate deposits by China Merchants Bank sent shockwaves through the industry and quickly circulated throughout online platforms. The document details the branch's past achievements, including annual deposit growth of 100 billion yuan and a record-breaking scale of 1 trillion yuan in corporate deposits. This has outpaced major state-owned banks such as Bank of China and Agricultural Bank of China in market share. For 30 years, the Beijing branch has weathered all storms, becoming a role model in Beijing's banking system. The proclamation shows that the branch is facing its darkest moment in its 30-year history, signaling a crisis for both the branch and Beijing itself. The language used in the document is intense, describing the current situation as a moment of life and death. It calls on all staff members, from frontline workers to back office employees, veterans to newcomers, to muster the conviction of fighting a decisive battle and the determination to persevere against all odds. This marks the beginning of what it terms as a race to save the Beijing branch. Corporate deposits refer to funds that commercial banks accept on credit from enterprises and institutions. On March 25th, Phoenix Finance, a Hong Kong media outlet, reported on the situation and quoted China Merchants Bank's customer service, saying they were urgently verifying the authenticity of the initiative, promising to release findings to the public promptly. However, what awaited the public was not the investigation's findings, but a complete suppression of the initiative across online platforms. Reports by Phoenix Finance and Chinese media outlets such as Financial World were also removed. Banks have always supported the real economy, which thrives or weakens alongside the real economic situation. The stark decline in corporate deposits at China Merchants Bank's branch in Beijing reflects the economic struggles of the city itself. In recent years, China has been facing a significant economic downturn, resulting in a notable decline across Beijing. This downturn has seen a rise in business closures, an abundance of for rent signs, empty commercial streets, and increasing vacancy rates in office buildings. Notably, in tech hubs like Zhongzhi and Yizhuang, vacancy rates for premium office spaces have soared above 20%. In other key areas, such as Wangjing, Financial Street, and the Central Business District, these rates have even surpassed 30%. This trend highlights the city's struggle with economic stagnation and diminishing vibrancy. Save the Beijing Branch initiative over corporate deposits underscores the growing pressures on banks. China Merchants Bank's branches in Shenzhen, Beijing, and Shanghai are among its largest, each with total assets of around 500 billion yuan. The significant 80 billion yuan drop in corporate deposits at the Beijing branch alone is alarming. On March 25th, China Merchants Bank released its 2023 financial report, showing a 1.64% decrease in operating income to 339 billion yuan, marking its first revenue decline in 14 years. The report noted a decline in both corporate and retail current deposits, while fixed deposits saw increases of 20% and 48% respectively, doubling the total deposit scale to 3.7 trillion yuan compared to 3 years ago. Corporate deposits, closely linked to business cash flow, reflect the slowdown in economic growth, reduced corporate investment, and declining business operations. As the largest private bank in China, China Merchants Bank stands out as the most profitable commercial bank among listed banks, with years of steady growth and an impressive market share that continues to expand. Serving nearly 200 million personal business customers, it offers a unique insight into the wealth status in China. Recently, China Merchants Bank's practice of reverse salary claim has once again drawn widespread attention from both the industry and the public. This practice involves the bank reclaiming previously paid wages from employees. In its 2023 annual report, China Merchants Bank disclosed that it had reclaimed performance-related pay from 4,415 employees, totaling 43.3 million yuan. This figure represents a decrease from 58.2 million yuan the previous year, but with a larger number of affected employees, increasing from 2,876 in 2022. Over 2 years, China Merchants Bank has reclaimed over 100 million yuan in performance compensation. As of the end of 2023, China Merchants Bank had a total of 116,500 employees. This indicates that 3.78% of its workforce had their performance-based pay reclaimed, averaging a reclamation of 9,805 yuan per person. China Merchants Bank is not alone in its efforts to reclaim performance compensation. Bank of China, one of the country's 4 largest state-owned banks, recently revealed in its annual report that in 2023 it executed performance pay recovery from 2,059 employees, totaling 22.8 million yuan. This equates to an average recovery of 11,000 yuan per employee. Bank of Tianjin, which is listed in Hong Kong, disclosed for the first time specific details about reclaiming salaries from employees. In 2023, it delayed the payment of 1.7 billion yuan in performance compensation, with a reclamation amount of 17.4 million yuan. Similarly, Weihai Bank, also listed in Hong Kong, announced in its 2023 performance report that it delayed the payment of 79.6 million yuan in performance compensation, with a reclamation amount of 272,800 yuan. In March 2023, regulatory authorities disclosed that during the merger and reorganization of 5 municipal commercial banks in Shaanxi, performance-based compensation totaling 33.4 million yuan was reclaimed from 61 executives and key personnel. Additionally, in March 2022, Bohai Bank reported the reclamation of performance-based pay from 370 individuals, amounting to 17.6 million yuan, averaging a reclaim of 47,600 yuan per person. Incomplete statistics indicate that major banks, including Industrial and Commercial Bank of China, Agricultural Bank of China, or Bank of China, have all mentioned the establishment of mechanisms for deferred payment and recovery of performance compensation. Reports indicate that the practice known as reverse salary claim is triggered by a system known as the Performance Compensation Recovery Mechanism. In March 2023, the former Banking and Insurance Regulatory Commission stated that over 95% of institutions had formulated and implemented systems for deferring payment and reclamation of performance compensation. Notably, among high-risk entities, these systems play a crucial role in holding accountable executives for violations and recovering asset losses. This suggests that banks reclaiming wages from employees can become a regular occurrence. Industry insiders have noted that alongside the recovery of performance compensation, there is also a push for the deferred payment of such compensation. One municipal commercial bank in Beijing has implemented a policy where 40% of its performance pay is deferred for no less than 3 years. Among this, the proportion of deferred payment of performance-based remuneration for senior management reaches 50%. The issue of banks reclaiming wages from their employees has sparked widespread discussion. Some online commenters have expressed confusion over why similar actions are not taken against executives in the real estate sector, which has seen numerous unfinished projects. One bank employee mentioned that despite a pre-tax annual salary of 300,000 yuan, they only receive 6,000 to 7,000 yuan monthly, with year-end bonuses ranging from 70,000 to 80,000 yuan. They highlighted the economic downturn's impact on the uncertainty of bonus amounts in recent years. Employees in the financial sector are facing significant risks. Last year, employees of the finance giant Zhongzhi Enterprise Group, which made headlines nationwide for its financial troubles, found themselves in a dilemma over the issue of returning salaries. On March 16th, Beijing's Chaoyang police issued a notice demanding that employees involved with Zhongzhi cooperate with authorities to return illegal gains and offered lighter penalties for compliance. Accordingly, employees of Zhongzhi's wealth management companies, including Hengtai Wealth, Xinghu Wealth, Gaocheng Wealth, and Datang Wealth, have also successfully demanded to return illegal gains. Other departments like HR, finance, training, customer service, and marketing are also required to comply. Inside Zhongzhi, the demand for returning payments has sparked internal turmoil. Sales staff reported being asked to return up to 5.6 million yuan, and financial managers were asked to return 2.8 million yuan. Even former employees who left in 2018 and had previously made sales were contacted for returning payments. An internal source from Zhongzhi stated that they were instructed to return previously received bonuses and salaries. Additionally, individuals close to Zhongzhi's wealth management firms mentioned that any income received during their tenure beyond regular wages could implicate them in the investigation. Zhongzhi, one of China's largest asset management groups with assets exceeding 3.7 million yuan, was considered a club for the wealthy, with investment thresholds starting in the millions and reaching up to 5 billion yuan for individuals. The collapse of Zhongzhi in June 2023, following defaults on its financial products, caused market panic and instability. In early 2024, Zhongzhi filed for bankruptcy liquidation. Economists believe Zhongzhi's fall signals the beginning of a major collapse in China's financial system. Before its collapse, Zhongzhi was a legally operating financial company with all necessary licenses, and it was not considered illegal to work for this company. Questions have arisen regarding why employees' wages became deemed illegal following the company's troubles, as these were legitimately earned commissions. Many people have used this income for significant life expenses, such as buying homes or cars. Now, being asked to return these wages feels like years of hard work have been for nothing. An online post shared a personal story of a friend, a former employee of the Zhongzhi Group that has recently been driven to desperation. Following the financial turmoil within the Zhongzhi Group, he was laid off and has since been unemployed. Due to his associations with the Zhongzhi Group, he has faced rejections from various companies while job hunting and remains unemployed. He received no severance pay from the company, nor has he been compensated for owed equity incentives. He's facing severe financial difficulties, and he has to rely on consumer loans to provide for his family, and now at the same time asked to return salaries by his old employer. The reverse salary claim incident has heightened concerns among financial sector employees about their financial security. For workers, the prospect of having wages reclaimed adds to their financial pressures. Salaries are essential for maintaining their livelihood, and delayed payments could lead to difficulties in covering rent and living expenses, affecting the quality of life for them and their families. The Chinese financial sector is going through a period of instability, marked by significant salary reductions and widespread layoffs, making it more difficult for employees than ever. As of September 30th, 2023, an analysis by China's media outlet Yicai based on wind data highlighted salary reductions and layoffs as key trends in the first half of 2023 among 42 listed banks. Despite the workforce exceeding 2.5 million, the growth rate was only 1%. The four major state-owned banks, Bank of China, Industrial and Commercial Bank of China, ICBC, China Construction Bank, and Agricultural Bank of China, are still laying off employees. Among them, ICBC reduced its staff by more than 9,000 within a year. The Chinese capital market, encompassing real estate, stocks, internet finance, and asset management sectors, has experienced various issues. The unresolved real estate debt crisis, hidden or shifted, poses a significant threat to the banking and financial sector. Recent financial reports from 20 listed banks reveal the real estate crisis is eroding their balance sheets, as evidenced by rising non-performing loan rates. According to financial reports released by Bank of Communications, the rate of non-performing loans in the real estate sector increased from 2.8% in the same period last year to 5% by the end of the year. While the balance of overdue mortgage loans declined, the focus on loans in this sector surged to 23%, amounting to 9.9 billion yuan. ICBC also saw an increase in non-performing residential mortgage loans by 9.6%, reaching 27.8 billion yuan. Zhongzhi Bank announced that due to the impact of non-performing loans, investor profits are expected to plummet by 30% in 2023. In fact, Zhongzhi Bank's bad debts have increased sevenfold from 2015 to the end of 2023. A situation mirrored by hundreds of financial lending institutions across China. Recent financial reports from a series of Chinese banks have shown losses. China Everbright Bank reported a 3.9% decrease in revenue and an 8.8% drop in net profit. Zhongyuan Bank saw a 16% decline in net profit last year, while Dongguan Rural Commercial Bank's net profit fell by 12%. CETEC Bank experienced its first revenue decline in 14 years. Guangzhou Bank's net profits have decreased for 4 consecutive years, and Shanghai Pudong Development Bank has seen 3 years of declining performance. A recent piece in The Economist highlights that China is experiencing a significant downturn in its real estate market, with major real estate companies in dire situations. This indicates the onset of a financial crisis. Almost 40% of the loans from China's large banking system are tied to the real estate sector. As the crisis worsens, banks are facing increasing pressure. Even though banks are hesitant to provide more loans to the faltering real estate market, the government in Beijing is pushing them to continue lending. This is pulling Chinese financial institutions further into the difficulties associated with the real estate crisis. Analysts have noted that the risks associated with the real estate sector and local government financing platforms are escalating. Coupled with weak consumer demand, these factors will continue to impact the performance of Chinese banks in 2024. Compared to larger banks, the outlook for China's smaller regional banks is ever more bleak this year. Greg Eep, an economics columnist for the Wall Street Journal, wrote on March 25th that the bursting of China's real estate bubble, coupled with local government's lack of funds and inability to repay debts, has escalated the financial system risks. He does not rule out the possibility of a financial crisis in China. Greg Eep believes that China is facing issues with a real estate bubble and local government debt, with the financial system severely exposed to these crises. Such conditions in other regions would be seen as precursors to a financial crisis. While some argue that China's debt is owed to domestic investors rather than foreign ones, and that the government supports most financial institutions, with Chinese officials being in control of everything, Eep suggests that this view might be outdated and risky. He also warns that although the Chinese financial system has limited connections with the global financial system, its sheer size means that any significant collapse could have a major global impact.